Hello, just coming live from Melbourne. I'm Praveen Gautam. I help entrepreneurs and enterprises to build a digital brand and monetize it. Right now, a lot of our clients and dental communities are asking about the federal budget 2020, which includes obviously taxes, assets write-off, JobKeeper, and many other things. So, as a trusted advisor, we understand it is important to help our clients to navigate in this current situations or uncertain times. So, if you are watching this from different social medias, including Facebook, YouTube, or that might be LinkedIn Live, a number of the channels, yeah, feel free to give a thumbs up, comments, or share this post to a wider community in dental community. Right, so let's go today. I'm very excited to welcome my good friend Albert Geigel, who is a dental specialist and he runs the firm MW Partners. So let's welcome Albert. Good day. Welcome to the show, Albert.
Thanks, Praveen. I'm very pleased to be here, and hopefully I can decode and explain the latest changes in the federal budget.
You bet. You bet. So yeah, that's a nice topic. Decoding road to recovery, decoding the federal budget. So 2020. So that's good. All right. On that note, I'm conscious as well. So please, yeah, get onto it. And there's a lot of things I would imagine to cover for you today.
Yes, but look, we'll go through them reasonably quickly, but I've really just made sure that I've kept it as simple as possible. And
Beautiful.
obviously, people's personal circumstances may be different. They can, put questions in or go through
Right.
the chat box if they need, and we'll answer them through the course or at the end of the question and answer session.
Beautiful. Beautiful. Now, thanks, Albert. And by the way, if you are watching this, if there's any specific question, just type below. Yeah, and I will, as it is relevant, I will definitely pass that to Albert and the team here, right? So let's jump into it. Thanks, Albert.
Okay, so the road to recovery or decoding the federal budget, one or the other. We'll go to the next slide. Thanks. So, as with everything these days, if it's related to any financial aspects, you need to understand this is general advice only, and in particular with the subject that I'm talking on, the changes come through thick and fast. They're as current and as accurate as I can make them, but obviously always seek professional advice for your particular circumstances. So we're going to run through the federal budget, and then we're going to look at tax structures generally, and we're also going to look at JobKeeper 2.0, 5 things that you absolutely need to know, plus questions and answers at the end if we haven't been able to cover them during the course of the presentation. So with the asset write-off, from the 6th of October onwards, for almost the next 2 years, up to 30th of June 2022, you will be able to write off assets of any value. So no longer do we have the $30,000 or $150,000 limit. It's assets of any value, and that applies to dental practices with gross patient fees under $10 million. There are certain different rules for those over the $10 million mark, so you'll need to get advice and clarification on that. The purchases relate to new and used equipment. So if you have purchased something that's used, you absolutely can to write that off. And if you have purchased something before the 6th of October, so maybe something that was under the old $150,000 or $30,000 rules, that you exceeded the level and you couldn't write it off in full, you can now write the balance of that off in full. Even assets that you may have purchased 5 or 6 years ago that are slowly being depreciated, they've just got a little bit left, and they're in what would be known as an asset pool, those can now be also written off. So we should see all dental surgeries having no valuable assets. Well, the assets are still valuable, but the cost of them will be completely written off by the 30th of June 2021. If you are looking to renovate your surgery, and some of that will be plant equipment, and some of it will be what is considered to form part of the building, such things such as partitioned walls, furniture or cabinetry work that's mounted on the wall, so it's fixed, electrical and plumbing. They do not form part of eligible assets under this write-off provision. So you need to check with your accountant to ensure that you can split up the renovation costs into those items that are considered depreciable items and can be written off, and those that technically form part of the building. The rules aren't clear-cut, so especially things like carpet, which would be attached to the building, obviously. There certainly are depreciable. Blinds, air conditioning units that are certainly affixed to the building, they can be written off. They're considered to be depreciable plant. So it's something that you need to consult with your accountant to make sure that you get all of the assets that you're able to write off written off. So now if we go over to the tax changes. Okay, so the rate changes that were announced in the prior federal budget that weren't going to take place until 2023 have been brought forward to now. So they will apply from the 1st of July 2020. So they're in place right now. The legislation has in fact passed. And so the thresholds and rates have changed, and they're in that table sitting right there. In conjunction with the subsidy amount that's there, a tax offset that's there as well for low to middle income earners, taxpayers that earn above $100,000 will be saving between $2,445 and $2,745. So in between that, even those that are earning significantly more will still get a minimum of $2,445 as a saving. Now, the other thing is when tax rates come down, there's always that comparison between your personal tax rate and what a company tax rate is. Because obviously companies at a 30% or 27.5% flat rate are often a better vehicle to have taxable income directed to if you're already on highest marginal rate. Now, with these reductions, if you're on around $150,000 or you're allocating income to a spouse up to $150,000, their tax rate will be less than 30%. So subject to how much profit you have to allocate, it's a time to consider whether you should or shouldn't be using a company. If there's not a lot of tax saving to be had because the rates have now come down, then you might want to be avoiding the administration and the costs associated with running what we would call a bucket or investment company for your practice. So now there are, on the next slide, 5 other issues under the federal budget, and that is that companies can offset current losses against prior year profits. Now, most dental practices do not operate through a company; they operate through a trust. But if you are operating through a company, what this means is if you have made a loss this year, or you made a loss last year, or in the future years, you can take that loss and offset it against a previous year's profit. When you offset it against a previous year's profit, what you actually get is a refund of the tax that you paid in that year. So no longer do you need to carry that loss forward to a year in which you make a profit in the future. You can go backwards and get the taxes that you've paid back. So there may be some dental surgeries that may want to look or consider that aspect. Also, state government grants are taxable. However, the federal government has announced to all of the state governments that if they apply, that their grants can be tax-free, or non-taxable is probably the better word. The Victorian government has taken up that offer, and so any grants that are applied for or paid after the 13th of September 2020 are considered non-taxable. If you've received it before that date, bad luck, it's still taxable. Also, if you've got apprentices and trainees, you can get 50% of their wage subsidised up to $7,000 per quarter. And that's during the period 15th of October through to the 30th of September next year. That's the application or start of the apprentices or trainees work with you, and carries on for 12 months. So if you put someone on the 29th of September 2021, you will get that subsidy right through to the 29th of September 2022. The subsidy does not run out on the 30th of September 2021. That period is just applicable for when you put them on. This applies for any new apprentice or trainee, and for anyone that you put back on the books. So if you did have them before, you couldn't continue on because of COVID, you can now put them back on the books and you can apply for that subsidy. Also, the bit that had a bit of controversy was the JobMaker hiring credit. That applies from any new employees that you put on from the 7th of October 2020. It's worth $200 per week for those that are under 29 years old, and $100 a week for those aged 30 to 35 years old. Important to note, you do not need to pass the 30% asset test. So even though you may not have JobKeeper or those things applying, you can still get this, but it needs to be a genuine increase in the people you have on your books. So there's a number of, as they would say, T's and C's, so terms and conditions. So the person you put on must have either been on JobKeeper or JobSeeker prior to getting a job with you, and it relates to your average level of or number of employees that you had on the 30th of September to see whether you have in fact increased your number of staff. So they're trying to avoid situations where people are just going, oh, I'll put 5 people on and then I'll knock them off after a bit, then I'll put some more on and I'll keep getting this subsidy. So that's not going to be the case. So just before I go to the next slide on tax structures, I'll just go across to Praveen to see, have we got some questions sitting there? I can see one on the chat screen, which I'm
Thanks,
happy
Albert.
to answer.
That is very good. So if you're watching this, I can see a number of the viewers. If you have a specific question, feel free to just type the questions. I have got a number of questions, but let me bring out one question very, very quickly. Here we go. Can you read that? Does the assets write-off apply for those items in a chattel mortgage or similar? Thanks, Dr. Chi Chang. So yes. Please.
If you have purchased an asset and financed it by chattel mortgage, you own the asset and you owe the bank the money that you've financed for it. So because you own the asset, you're able to write off the asset. So those that are under chattel mortgage are able to be written off under the asset write-off. You cannot write off any assets that you have financed by way of lease. So if the equipment is leased, it means you don't own it. The finance company actually owns it. So you don't have an entitlement to a write-off. You have an entitlement to claim each and every lease payment as a 100% deductible item. And while I'm at it, one of the things that I didn't mention is the asset limit, which is now unlimited, does not apply to motor vehicles. They are still subject to the luxury car limit. So you cannot buy your $500,000 Ferrari and claim it. You will be subject to the 58,000 luxury car limit for the claim on that Ferrari. But all other assets and equipment, perfectly fine, irrespective of what their value is.
Thank you, Albert. I hope, Dr. Chang, that give you a bit of idea. But if there's any specific questions, please feel free to email at info@mwpartners.com.au, and Alison and the team will certainly go from there. So let's move to the second topic today, Albert, tax structure. So I will hand over to you, yeah?
Okay, thank you. Okay, so tax structures. Now, these come up all the time and nothing's really different under COVID or any of the incentives. But just because a lot of businesses are now looking at the way that they're engaging staff, as well as the way that they're engaging contracting dentists, I need to reiterate, and this has come up in a number of my webinars, that there is no tax advantage for an ABN contracting dentist to operate as a company or trust. And the reason for that is the income that is being generated is personal services income, and they are not allowed to keep any of the profits in the company. They must all be paid out to them. So therefore, there's a flow through and no advantage to being able to use a corporate tax rate, because there won't be any profit left to do it. And neither can they use a trust to be able to distribute any of that income to another related party. All of the distribution from that trust must go to them because it's subject to the personal services income rules. If a service and facility agreement, which is becoming a lot more popular later, is still appropriate, or if you're going to move to a service and facility agreement, do not change your method of operation until after COVID. Now, that's a pretty open date, if that's the right way to put it. But the situation is that, as we've seen in the past, the tax office and the federal government are looking at comparing your business in the COVID environment to what it was in the pre-COVID environment, such as the current JobKeeper 2.0, where you're reviewing your business activity statement from September 2020 back to September of 2019. Now, if you've changed your operating method, it's going to throw out your revenues and the income that you're putting on your BAS, which is the only figure they look at. They do not look at your expenses. They are only interested in a fall in revenue, and using a service and facility agreement will affect your revenue that you're putting through on your BAS. So don't do it. I would usually recommend that you waited until at least probably the end of January, when you're reasonably certain that you won't be getting any further JobKeeper payments, and you've got a better view on what COVID's actually doing. The other bit is just to have a review of how you're currently operating. Most of the dentists that are running a dental practice are aware as to whether they are a standard trading entity. So that would normally be the larger dental practices with a larger number of practitioners at the practice, or whether they're operating as a service entity, which is where the principal dentist and other dentists are typically receiving 100% of the patient fees and merely paying a service fee to the trust to have their business arranged in that manner. It's not a one-size-fits-all. So with COVID and with trying to get the road to recovery out of COVID, it would be preferable that you reviewed that structure with your accountant to ensure that you're getting the maximum benefit out of that. So that's all I have on the tax structures. So now if we go over to JobKeeper 2.0, which all of you are now busy trying to see whether you comply with the 30% reduction or not. So the reduction, as I said before, is strictly from the September 2020 quarterly BAS to the September 2019 quarterly BAS. It needs to be on what they say all fours with the way that you're recording. So if you were doing your September 19 BAS on accruals, you cannot now change to cash. Okay, if you were doing it as a service entity, you can't now change to a trading entity. You can't try to manipulate the system. You need to be very cautious with the way that you are applying the rules. Now, if you are a borderline case, or if you are one of the practices that perhaps weren't operating in September 2019 because you're a newly acquired practice or you had a significant change to your business operations, you then need to sit with your accountant and look through the alternative rules to see if you would comply. Because just putting your two BASs in is going to raise a red flag, and you are going to be asked a please explain by the tax office before you receive any of the JobKeeper. For those of you, and I've heard of a number of, let's call it schemes or different methods of accounting for their revenue, the main issue is this: you are unlikely to have the tax office knock on the door day one. It will probably be 3 or 6 or maybe 12 months down the track. If you have manipulated your figures so that you've got JobKeeper and you have paid your staff JobKeeper and you then find that you don't comply, you will be paying back to the tax office all of the JobKeeper plus penalties, and it's very unlikely you'll be able to recover any of that JobKeeper from your staff. So think twice before you consider manipulating your figures for JobKeeper. The other test is whether the people are going to be on the higher tier or the lower tier. And the test is whether they were working 20 hours a week or 80 hours in the month of February, which has also been extended to the month of June. And the month of June will more likely apply to either casual employees that hadn't been with you for 12 months at February, or for employees that have started with you recently, etc., or moved from one employer to the other. You need to look through your records and see whether either the 80 hours worked in June or worked in February. Only have to be in one of those 2 months, and then you can determine what rate the employee is on. The employees are fairly easy because you can just go back to payroll records. Business principals are a bit more difficult. They need to be actively engaged in running the business. And the tax office hasn't given a lot of clarity as to what that means, but they say they are taking a common sense approach. So if the spouse that might be nominated as the business participant is maybe doing a little bit of bookkeeping, has never stepped foot inside the surgery, then don't push your luck and make it, a full-time rate. Stick with a part-time rate. If you are in fact the principal dentist and you don't normally draw a salary, and that's why you're on the business participant rate, then obviously you would be working more than 20 hours a week. It's quite easy to show you're actively engaged in the business for that period of time. So again, common sense approach. And I always look at it that if it happens to be you, me, and the tax office all sitting in the room together, are you able to explain how you're spending that 20 hours a week and that's reasonable given your particular circumstances for your business? Also, if you don't pass the 30% test, you should also look as to whether you are above or below the 10% fall in revenue. So if you're more than a 10% fall, you're what's known as a legacy employer. So you still have some rights to change the working conditions for the employees who now are no longer on JobKeeper with you, but for which you may not be able to offer full-time employment. It may still only be part-time in your surgery, or there may be a change in their working conditions. They may have different job specifications that they're doing. They may be not just chairside. They may be having to take over reception or do some administration work in conjunction with their other duties. So the legacy employers can still utilise the changes under the Fair Work Act, and those they'll be able to carry forward through to 31st of March. Again, to be able to get, if you do pass all the tests, you need to advise the tax office of your actual monthly revenue for the previous month and what you expect to earn in the following month. This in no way excludes you from continued JobKeeper support. It's merely information provided to the government so they can better analyse the situation, and it's the trigger event for you to actually get paid your JobKeeper. The trigger event is not the lodgement of a BAS. It's not the registration for JobKeeper 2.0. It is in fact the notification to the tax office of your pre and post monthly revenues. So with that, I can go on to any further questions that people may have or anything that may be sitting in the chat box, Prabin. But that's really a good summary, I think, to allow people to push forward and get their figures to see if they comply with JobKeeper 2.0. I must also say that if you are looking at your figures now and you're thinking this is really going to be borderline or we don't think we're going to make it, it would be prudent to advise your staff that you are unlikely or that you're borderline on JobKeeper and they may not in fact be on JobKeeper going forward. I think that's only fair so that the staff know what the situation is. Obviously get those figures tallied up as soon as possible, and if you think you may be someone that would be able to use the alternative rules because you're borderline or your circumstances are unusual, then they are complex. Please talk to your accountant to make sure that you've left no stone unturned to try and get the JobKeeper, but by all standards, you need to make sure you have complied.
Thank you, Albert. That was very clearly, as I can see, just Dr. Segal Jacobson from Melbourne. Thank you, Segal. So yeah, very clearly explained. So obviously you have talked about federal budget, tax structures, and JobKeeper 2.0. I hope we won't get onto a 3.0. So it's already hard to navigate, there's so many things, and I can understand, a lot of the dental clients and our communities are a little bit confused about, but I hope that's been very clear. Now, I'm conscious with the time. We are already running out of the time. Is there any final questions or anything on this topic? Anything you want to add on?
Not for me. If you've got some other questions, I'm more than happy to answer them.
Probably there's a couple of questions. I think the best way is, I will pass that to info@MW Partners, and those viewers who are watching this right now, if you have a specific questions, and I can see that there's a number of questions people have on this specific, so definitely I'll ask Alishan to follow that app as well. Anything before we wrap up this live today, Albert?
No, not for me. Just again, I hope all the dental surgeries are, progressing and working their way through what is, very difficult times for everybody. And it's quite easy to look at the restaurants and the other businesses, but it's the whole, almost food chain, if that's what you want to look at. It's people who manufacture, who supply to different businesses who are not operating, and the like. So it's difficult for everybody all round. Even from our point of view as an accounting practice, we've had, we haven't had a downturn, but we've certainly had a really big spike in queries from clients and trying to ensure that, they've received what they're entitled to, that their businesses can survive, and not only that survive, come out the other side more vibrant and better able to cope with all the circumstances, because the virus isn't going away anytime soon, and we need to be, vigilant with what we're doing. You only need to look at Europe now and other places where they're now back into really large spikes and closing down their economy yet again. So we're certainly not out of the woods yet. We really need to be prepared, and we need to look after our businesses as best as possible. And one of the best ways is just to stay on top of your finances, stay on top of your figures, talk to your accountant. There's never a silly question. Things change so rapidly that you need to come forward and get the advice when you need it. So
Great.
I'm always happy to give that advice.
Thanks, Albert. I appreciate your insight, and I hope the members have, really find these sessions are valuable. So definitely they can email at info@mwpartners.com.au, and Alishan and the team can follow it up. Thank you, Albert.
Okay, thank you.
Cheers. So I hope you find the sessions valuable. As a trusted dental advisors, all we're doing here is to help our dental clients and community to stand in their feet in this difficult time. So in this, if you find this session valuable, feel free to like, comments, or just send us a quick feedback. You can email me directly at praveen@viznetwork.com.au. Thanks for watching, and I'll see you in the next one. Bye for now.